All right, we're going to go ahead and get started. So where I left off the other day, we had a couple slides left in the content lecture before I get into the examples. Anybody have any questions on the slides we already covered before I move into the remaining content slides? Okay. So we're basically at the point where we were talking, we've already talked about depreciation. So as just a brief reminder, depreciation is, again, just a way of allocating a large cost over the same number of time periods that it will actually help our business to earn money. Okay? So at some point, we'll end up disposing of whatever assets we bought. So that journal entry I showed you all, that is the ongoing entry to record depreciation expense, debit to depreciation expense, credit to accumulated depreciation. You remember that is the way that we move the initial cost from an asset where we put it when we buy the asset to recognizing that as an expense. So each time we enter that journal entry, we're recognizing a little bit of that initial large cost as an expense that shows up on the income statement. Okay, so as we go accumulating depreciation in that account called accumulated depreciation, that is reducing our book value of the item. So our book value, as a reminder, is the total cost that we initially recorded minus any accumulated depreciation so far. Okay, so when we go to dispose of any of these assets, this is the process that we use to dispose of them. Okay, so it's kind of a four-part process, but these two bottom components, removing accumulated depreciation and removing the asset cost, that is just basically reversing out the initial debit entry to the asset account. So that's what this part is. So if we debited buildings when we bought a building, then when we go to sell it, we will credit that building account for the initial cost. We will also debit the accumulated depreciation account for whatever amount is in it. Okay? So at that point, the action of doing those two portions of the journal entry, that basically leaves us with book value. Because remember, book value was just total initial cost minus accumulated depreciation. So when we do these two journal entries, we're left with just having the book value there as a component of the journal entry. So basically, we look at whatever we received in cash, okay, or obviously if you had to pay someone to take it from us, then we would record that as a credit there. And the difference between what was in these two accounts and the cash that we paid or received, the difference, whether we have to add a little bit of credit or a little bit of debit to balance this whole journal entry out, depending on whether we have to add a little bit of credit to balance it out or a little bit of debit to balance it out, that will determine whether it's a loss or a gain. So real quickly, that can be a little wordy. So let's say we have an asset that cost us $100,000, and so far we have depreciated $80,000 of that asset. Meaning that when I bought the asset, it's just that value is just stored in the asset account, and it becomes an expense as I'm recognizing depreciation every time. Okay? About $100,000 to start. Okay, and let's say I have $80,000 in accumulated depreciation. Okay, just looking at those two numbers, we know that the book value of this asset is $20,000. The difference between those two. Okay, so right now as part of our journal entry, and this would be a debit to accumulated depreciation and a credit to whatever asset account this was, if it was a building or land improvement or whatever we're talking about here. Okay, and you see that right now it's out of balance by $20,000, a debit of $20,000. Okay, so if I gave away this asset and there was no cash involved at all, then the amount that I would need to balance this out would be a $20,000 debit. So that would show you, if I just gave away that asset instead of selling it to someone, that when I gave it away, I would be recognizing a loss of $20,000, which should, I know it's kind of confusing, but if you think about what's actually going on here, this should make sense. So when we initially buy the asset, we say, hey, we've got an asset that will give us $100,000 of value over a certain amount of time. As time passes, we recognize expense related to the amount of this asset's useful life that we have used up, right? Any amount that's gone into accumulated depreciation is expense that we have recognized related to this asset, right? So when we bought the asset, we planned on using, assuming we didn't have a salvage value and we're just going to use it up, we planned on using $100,000 of value. We only got to use $80,000 of value, so we had $20,000 of value sitting there that we were unable to use before we got rid of this asset. So it should make sense that we're saying, hey, if we gave away that asset at that point, we lost $20,000 on it. On kind of the other side of that coin, if we say, instead of getting no money for it, let's say that we got $40,000 in cash, which is a debit. Okay, so now, if we look at the three components that I have so far, I've got a $100,000 credit. If I add up my debits, I have $120,000 on the debit side. So if I look at the missing piece here, it's going to have to be a credit of $20,000, meaning that this component of the journal entry would be a $20,000 gain on the disposal of this asset. Okay, so yeah, does anybody have any questions on how that functions? That's kind of the last component of depreciation that we really need to talk about. Yes, sir. Right. Well, let me show you here. Okay, so let's see. This will be a little hard to read, but hopefully I'll make that point. Right. I know it's hard to read, but this is my actual writing out of the journal entry. Debit to cash, $40,000. Debit to accumulated depreciation, $80,000, which is down here. Credit to buildings. This is me removing the asset from my buildings account if I was selling it. So once I have those three components up there, I'm just looking for whatever I need to balance it, right? So at that point, depending on whether I need a credit or a debit to balance it, I'll know whether I need to report a gain or a loss. And so for this one, it would be credit, gain on sale of asset, or this could be any number of names of this account, but you have credit gain on sale for $20,000. So if you broke even, there'd be no gain or loss, and you would just eliminate this component of the journal entry because you would already be balanced out there. Everybody with me? All right. So again, if you're just, without doing all that other stuff, if you just look at the book value, if you kind of got an ongoing tracking of the book value. If you get cash that is greater than the book value, that's a gain to you. If you get cash that's less than the book value, that's a loss to you. If it's the same as the book value, no gain or loss is recognized. Okay, finally, the last asset class that we talk about that kind of falls in this category are intangible assets. Everybody know what an intangible asset is? What does tangible mean? You can touch it, right? So intangible would mean you can not touch it, right? So this would be, I mean, tons of stuff falls into this type of asset these days. What's that? Yeah, software, anything related to the software side of a computer. You've got art type of copyright, patents, those types of things. And then you also have a big one in the business world called goodwill. Anybody know what goodwill is? True. In business, and specifically when we talk about intangible assets, we won't spend a ton of time on this, but goodwill basically means the good name or the good reputation of the company, which would also be an intangible asset. So just as an example of goodwill, if I have a six-pack of Coca-Cola, and right next to it I have a six-pack of Cola, that's just the off-brand, and even assuming I have the exact same formula, the Coca-Cola brand is going to sell more even though it's more expensive because they have developed this reputation in the marketplace. People know what they're getting when they drink Coke versus some, obscure off-brand. So just the fact that the identical thing is in a Coke packaging label, that has value to it. So that's what goodwill is. Why are these kind of separated out? Well, one reason is that some of them, similar to land, really don't become less useful later on down the line. Or if they do, it's very difficult to pinpoint when they will become less useful down the line. Goodwill would be an example of that. Okay? There are some intangible assets that have very finite lives, like patents. Right? You don't have an indefinite patent on something. They're granted in time periods. So if you think about an intangible asset that has that type of fixed lifespan, say 10 or 15 years, you can see how those types of assets, it would make a lot of sense to treat very much like buildings, land improvements, other types of fixed assets that provide benefit over a long period of time. And because that time period is finite and we know how long that is, we can follow the matching principle and try to assign expenses associated with that particular intangible asset over the lifespan of time that will provide revenue to the company. So again, similar to all of the other types of categories we talked about, when we talk about what goes into the initial reporting of cost for intangible assets, this would include these types of extras as well. Okay, and like I said, we won't talk too much about other than just introducing the idea to you. If you take intermediate, you'll talk more about intangibles and accounting for them. Your book goes into it more. But basically, you treat them one of two ways. You either treat them very similarly to land, where they don't have a finite life, and you therefore are not going to depreciate them because you say, hey, this is going to provide me the same amount of value forever. Okay? Or you treat them like a land improvement or a building. If you have a fixed time period, 10, 15 years, and you can say, hey, whatever costs associated with this asset will be used up, or the value associated with that, the revenue generating value associated with these costs will be used up in this specific time period. Okay, so whatever the name of your account is for these intangible assets, and you may have many accounts that hold different types of intangibles. Obviously, that's going to vary depending on what type of business you are. But if you determine that you're going to treat them like land where they don't have a finite life, you still would record all fees and everything associated with the intangible asset in that initial journal entry: debit to the asset account name, credit to cash, right? And the only difference would be if it's something with a finite life, then you would then depreciate that over the lifespan of the item, so that you would eventually recognize all of that as an expense. If it will give you value indefinitely, then you will just treat it as an asset indefinitely, right? You have, I don't really need to explain that anymore. If you have an asset that's going to give you the same value forever, then obviously you don't want to say, hey, I'm only using a certain portion of that value of this particular time period. All right, so any questions there? That's the last, I believe, the last of the content. Yes. Okay. No questions there. We will move into some examples here. Let's see, that's pretty hard to read. Let's see how far back I can go. Back row, you guys able to do that at all or no? Not really. Well, I'll talk through it. I'm recording this, so if you wanted to see it better and you can't, A, I will have these slides put up, but B, you can come back and look at the recording if you want to. So, first question. Cala Manufacturing purchases a large lot on which an old building is located as part of its plans to build a new plant. Negotiated purchase price is listed, and then we have these various other costs. Let's see. Seeing what the question is. Okay, here. Prepare a single journal entry to record these costs incurred by Cala, all of which are paid in cash. Okay, so basically we have a number of costs associated with this purchase. And what do we need to do? Well, we first need to determine if all these costs are going to go into the same asset category. And if so, then we will debit the asset category that they go in, and we will credit cash there. So if you remember, we said that there's a bit of a caveat when you're looking at a purchase that involves land with building and other such items, because the land obviously has to be handled separately. So in this case, this one is a little bit more confusing than I probably would have written if I did it myself, only because we have this component that is actually going to go into land, that is us tearing down an old building that sits on the land in order for us to prepare the land for its intended use for us, which is building a new building. Okay, so in some of the examples that I walked through when we were talking about the content portion of the lecture, I showed you, hey, could be divided between land, land improvements, and buildings is often what you will see in a purchase like this. And you either have to be given explicitly the numbers associated with each category, or you have to be given the market values, and you got to figure them out yourself. In this case, we're given numbers for all these. So all you have to do is divide out these categories, add up the numbers that are going into land, which you see would be the $280,000 for the lot, plus $110,000 for the building that's on the lot, plus the money that is required to tear down that building, right? And then the amount that is required to basically get rid of the evidence of that building being there. So filling in the, basement or whatever is required to get it back to the condition it was in before. So those would be my amounts going into land. I would just add those up, and it would be a debit to land there. Land improvements were given down there as lighting and paving. So that's the 87.8, and then we're given construction costs on the new building as well. Yeah. So add all those all up together, and that will be my credit to cash. and obviously those are divided between those categories. So really the only question here is, do you know that you should divide these into these three categories? And then in addition to that, do you know which amounts should go into land? And I certainly wouldn't blame you all if you weren't sure what to do with the money associated with tearing down an old building. That's a little bit more of an ask than I would normally say. Okay. Any questions on that one before I move on? All right. Let me get back here. All right. Rodriguez Company pays $375,000 for real estate, plus $20,000 in closing costs, for a total of $395,380. Of that, the real estate consists of land appraised. Okay, so this is a very similar question. We're going to have to divide this out, but now we're going to do what I showed you all with the values, where we're going to look at these items and try to determine which percentage of my total price that I paid should be allocated to each of those three categories. So again, in the journal entry, whoops, guess we're not going to the journal entry yet. When we determine what the value is that we're trying to allocate into these three categories, you recall, first thing we do is look at what the market value is for these items. That would be that bottom section there where we're talking about appraised value. So the denominator for our ratios to get the percentages we need is going to be the total appraised value of $392,600. Someone pull out a calculator for me, because I'm certainly not going to be able to do this math in my head. So for each of these three categories, we're going to take the appraised value of, starting with land. So we got appraised value of $157,040. So if you take $157,040 and divide it by $392,600, what does that give you? 0.4. Nicely round number for us. So that would be 40% if we translate that to a percentage. So 40% of what I actually paid should be allocated to land. For land improvements, we look at 58,890 divided by 392,600. Say again? 392,600. 392,600. So for land improvements, we're taking just that number, dividing it by the total appraised value there. And this is just giving us the percentage of the total appraised value that is related to land improvements. About 1.5. Wait, about 1.5%? No. All right, so we must have done that wrong. Let's try again. So we got 58,890 divided by 392,600. What, 0.15? Okay, so 15%. So 15% is allocated to land improvements. Again, just based on that number divided by that number. And then finally, the building, 176,670 divided by 392,600. So it was 176,670 divided by 392,600. 0.45. So 45% of the total value should be allocated to building. Okay, so they're just going to set up just like I did and take that 100% value, 392,600 as the denominator, and go through and find out what the percentage is for each of those. So that's not the last step. The last step is to then take those percentages and multiply those times what we actually paid for this asset. Because you can see what it appraised for and what we actually paid are two different numbers there. If they're the same number, then once you've figured out the appraised value, I mean, you don't really have to change anything. That's just the percentage that's allocated to each of them. But in this case, we take 0.4 times 0.4 times 395, 380, which is right there. And that gives us 158, 152. That would go into my land account. 59, 307 would be going into my land improvements. And 177, 921 would be going into building. Okay, so those would all be debits to those accounts. Debit this amount to land, debit this amount to land improvements, debit this amount to buildings, and then a credit to cash or notes payable or however you paid for this. Okay. Any questions on that one? Again, like I said, we will not, at least on the exams, I will not ask you to actually find these percentages on your own. Okay. All right. Next question. Ramirez Company installs a computerized manufacturing machine in its factory at the beginning of the year at a cost of $85,600. Machine's useful life is estimated at 10 years, or those units of the product, and there will be a $12,100 salvage value. During its second year, the machine produces 26,100 units of product. Determine the machine's second year depreciation using the straight line method. Okay, like I said, I didn't write all these questions, so don't blame me, but this is a typical book question where they're trying to throw you off the true answer, which is actually pretty easy to get by throwing in some information that you don't actually need here. Since we're actually asking for straight line depreciation, all we need to know is the initial cost, the salvage value, and the length and time this would be useful for us. So the fact that it's giving us units of production here in the information, that's just extra information. It's called a red herring. It's just trying to throw you off. Just so you're like, hey, I see units of production, maybe I should be doing some calculation with that. Okay, but we're not. So all we got to do is take 85,600 and subtract from that 12,100, which is what? 73.5. Okay, so that is depreciable cost. So that's the amount there that I want to allocate over the number of years that I will be doing this. Okay, so how many years was that? 10 years, we said. So that means 73,500 divided by 10, and that would just give me $7,350 per year for depreciation. Assuming I did the math right. There we go. I did. $7,350 per year. And again, once we figure that, if we're doing the journal entry, that would just be, for that year, it would be a debit to depreciation expense for $7,350 and a credit to accumulated depreciation for that same amount. Say again? So it's asking about the second year here, but for straight line, all of them are the same, right? So we don't really care. Again, the fact that it's throwing that in there is more just to try to throw you off. Okay, anybody have questions on that one? This chart that it's putting up at the end here, again, is just walking you through these numbers laid out here. Of course, since the question was what was the second year depreciation, you don't really need to put it out in a chart like that to figure that out. On some of the other ones like double declining balance, that might be more helpful. But since we know for a straight line it's going to be the same amount each year that we depreciate, you could say what's the depreciation in year 8 or year 9 or year 7, and I would still say the same thing. What's that? Yeah, I mean, there's a lot of, if you got to make sure you're getting your terminology straight, or you definitely will be confused. Okay. I don't know why we need to see all 10 years here. Okay, so now, similar scenario here, but we actually are concerned with units of production. So the fact that we have that in there is important to us. But for this question, the fact that we've thrown in the useful life estimated at 10 years, that part of this question would be your red herring, because we don't really care how many years we estimate the useful life at if we're using units of production as our depreciation method. Because regardless of how many years it takes to get there, we won't reach the amount of depreciation we need to recognize until we hit the number of units of production that we have assigned as our depreciation driver. So what do we need to do here? Well, again, we need to find depreciable cost. Okay, so this was what? 43.5 minus 5,000. Did I leave off? Oh. Say about it.
I think you put 38,500, but it's 338,500.
Oh, this is, yeah, I'm not there yet. You're just getting ahead of me. But yeah, I wrote what you see there, but I meant to. So right here, we're just looking at depreciable cost, right? So I need to know how much money do I eventually want to recognize in depreciation. That is my depreciable cost, right? So for straight line and for all three methods, the depreciable cost doesn't change. No matter which method you choose, you take your starting value, you subtract out salvage value. That gives you the amount that you want to divide up based on how you're recognizing depreciation. So it's this 38,500 that I will then divide by 385,000 units. It made that nice and round for us, which is nice. Okay, so that would be what? Just move the decimal place over right, so that would be what is that? How many points over are we talking here? Are we talking 1 cent or 1/10 of a cent? It's too early for. Actually, I never want to do this kind of math, to be perfectly honest. Someone with a calculator do that for me. One of those, either a penny or a tenth of a penny or a hundredth of a penny. I don't really feel like messing with the decimal. No, I'm sorry. That's just good. That's me running out of space there. That's just divide 38,500 divided by 385,000 is what? 0.1. So 1 cent. Okay, so we got 1 cent per unit of production that is going to be recognized as depreciation. So we just take that. You said 0.1 or 0.01? So 10 cents. Okay. So 10 cents per unit means that we will take 10 cents and multiply times 32,500, and what does that give me? 3250. Is that right? You with me there? So in the second year, I looked up here and it says, okay, in the second year I used that many units. This calculation here, 38,500 divided by 385,000, that gave me a cost of 0.1 or 10 cents per unit. And that just means for every unit this year that I use of production, I will charge 10 cents against depreciation. Okay, everybody with me? So, again, that amount would go into the same journal entry, debit to debit to depreciation expense, credit to accumulated depreciation. Whoops. Try to get all that on the screen before I jump to the next one. What time is it? I didn't bring my phone with me. Yeah, we got a little time left. All right, I keep jumping past it. Anybody have questions on that one? I'll go back to it. All right, pretty self-explanatory. I don't think I meant to put this one on. This is very oh, here we go, yeah. So similar fact pattern, but now we're asked to use the double declining balance method. Okay? So this time the units of production, again, is what we don't really care about, but they give it to us anyway. What do we care about? Well, first step is to look at how many years the useful life under straight line would be. Okay? And I said one way to look at the percentage that is tied to that is just take 100% and divide it by the number of years of useful life that we have. So 100% divided by 10 years, okay, means 10% per year is the amount under straight line that I would use of my depreciable cost in depreciating each year. Okay? So since this is the double declining balance method, I take that and I double it. So that means 20% is the percentage that I will use to depreciate. So each year, I will look at what the book value is at the time point where I'm calculating depreciation. I will look at the book value, and I will multiply that number times 20% each year until I get to my depreciable cost. Okay, so it's asking for second year. So in the first year, I guess I should come up with what depreciable cost is so I can eventually get to that. But since we're not going to get past the second year in this question, I won't do that. We'll just look at the initial cost, $85,600, which before you do any depreciation, the initial cost is the book value. Okay? Until you have something in accumulated depreciation, initial cost is book value. So year one, take 85,000 times 20%, which we got down there, okay? And that is the amount that I will recognize for year one depreciation. So that would be what? 8,560 would be 10%. So 17,002, is that what you said? Oh, yeah, you're right. 17,120. Okay, so year one would be 17,120 would be my depreciation expense or depreciation recognized. Okay. What's that? What does that leave you with?
68,480.
Okay. So in year two, 68,480 is my new book value, which I got by just taking initial book value minus this depreciation I recognized in year one. Okay? So then I would take that amount, 68,480, and I would multiply that times 20%. Is what?
13,696.
13,696, which would then be year two depreciation. Okay? You would keep doing that until the total amount that you recognize in depreciation equals your depreciable cost. So the last year that you do that, it will not be the 20%, likely, unless you just got really lucky. It will be some portion of that 20%, but it will be all that you need to recognize to get yourself to the total cost. Yes, sir?
Why did you go with
Okay, that is because this method we chose is called the double declining balance method. The reason it's called that is because of the double. Okay? Any other questions on that? Make sure that they're getting the same thing as me. We got 17,120, which was the same first year that we wrote. 13,696. Looks good to me. Okay. So, I'm sure it'll make me click through all 10 years here, or I guess less than 10 years. Okay, so make note of that. This is what I said at the very last year. If you do the 20%, you will end up with a book value that ends up being less than what your salvage value is, which means you would have gone too far into your depreciation. Okay, so that means that the last year, whenever it says forced, that just means it's going to be less than the 20% because all that you have left to get you from where you were right here, I know it's a little hard to read, 14,361 down to 12,1, which is the salvage value, which would mean you've used up all your depreciable cost. Once you get there, the amount needed to get there ends up being less than the 20% you would have calculated, so you just use the amount needed to get to book value. Again, like I said, other than maybe one or two, probably maybe one question on a quiz, you won't see this on the exam. Okay? But it does happen in real life pretty regularly. Okay, any questions on double declining balance? Okay, I would say the two places people most often get confused is most people can do the 20%. Most people get confused with whether or not they need to use the salvage value in double declining balance at all, because the first couple steps you kind of ignore salvage value. But yes, you use it. The easiest thing to remember for me, I think, is no matter which of these categories or which of these types of depreciation you use, you will always only depreciate up to what your depreciable cost is. All right. This is very similar to the straight line question we already looked at, so I'm not going to walk too slowly through this, but this is just using the numbers we have, 154,000, salvage value of 25,000 over 4 years. This is just showing the table that we drew in the other examples as well. But again, for straight line, this is pretty simple. You start with the initial cost as your beginning book value. From that, you subtract out the amount you figured for annual depreciation, which will be the same each year. So the year-end book value, of course, would become your next year's beginning book value. You would subtract out the same amount of depreciation each year until you have nothing left. Okay, or in this case, you're down to the salvage value that you initially started with. Anybody have questions? Again, it's pretty similar to the example we already looked at with straight line. Whoops. Should be easier. Oh, too far. We'll get back to it. I hate clicking through all these. How am I doing on time? How much time is left? Okay. I usually try to end about now, but We got 20 minutes still if I have to go further. All right. Oh, you're saying why you have that last year on there? That's just because we said, hey, we think this is going to last for a 10-year time period. So they did out the table for the full 10 years. But obviously that last year there is kind of superfluous. All right. Early January 2015, Newtek purchases computer equipment for $154,000. Plans on using it for 4 years. Oh, that's one we just did. Sorry. Push click 100 times here. Oh, this is the one you're asking about, right? Well, this one is showing you. Yeah, this one is just stopping there. I don't love when they list it out like this because it is somewhat confusing to see a value there still. But as long as you remember that that is the salvage value that you were already talking about, you'll be fine. All right. Same thing, but with double declining balance. So again, 4 years would have been, in the previous example, 25% of our depreciable cost would be recognized each year as depreciation. But since we're doing double declining balance now, instead of 25%, which was the straight line value, we doubled that to 50%. So at 50%, 154,000 times 50% gives us our first year depreciation, 77,000. Then that same 77,000 is what's left over because obviously that was half of the original value. So now we do 77,000 times 50%, giving us half again. Third year, 50% of that would have been the depreciation, but since that amount would bring us down below the salvage value, all we're going to do is the difference between second year ending book value and salvage value. Okay, because all that's left here to depreciate is the difference between our 38.5 beginning book value in 2017 and what it needs to be at the end of that year. Well, 200% is just their way of writing double. So it's saying, hey, double whatever the straight line value is. So, yeah, they're just saying, hey, instead of saying 2 times 25%, we're saying 200% times 25%. They're just their way of writing it. All right. So you still are confused, Yanzo? Okay, it's not written extremely well here, but
I would figure it out. It's just, it's going by what the book says.
You know how we got to the 50% depreciation rate. Okay, so once you get to that rate, the rest is easy because all you're doing each year is looking at the beginning book value, the rate, and as long as whatever you figure as the annual depreciation wouldn't have you adding that much depreciation, as long as that wouldn't bring you down below the book value, then you go ahead and add it. If whatever you figured for annual depreciation would have you down below book value, then instead of that number, you just figure out, well, what do I need to get me from here to book value? Okay? And in this case, it was 13.5. So for a fourth year there, we would have no depreciation recognized. So it doesn't mean necessarily that we wouldn't use the asset, just means that it is fully depreciated at this point. All right, so another example of straight line depreciation. 5 years, $280,000 initial value, $40,000 salvage value. So that gives us $240,000 a year, and we want to divide that by 5 years. What is that? $48,000 a year. So each year, our depreciation expense will be $48,000. Oh, I'm sorry, I didn't even look at that. So I made the mistake that a lot of you will probably make, which is when looking at the factual scenario, always check to make sure you're talking about, or look to see how much of the year you're talking about. Okay, up to this point, I've kind of got lazy because for a while the book always starts you out on the beginning or end of the year. And eases you into that. So now we just have that slightly added wrinkle of the first year being a partial year. So all you got to do, instead of the full amount of depreciation that first year, find out what portion of the year we're talking about. In this case, it's 3/4 or 9/12. So you would multiply 75% times 48,000, and that would give you the amount to recognize this year. Okay. So once you get that, the rest of the years will still go the same way, except obviously the last, or the 3 months associated with this year that you didn't recognize would bleed over into that last year when you're recognizing the final, whatever that is, however many thousand that is of depreciation expense. So this one only asks us for year 2 depreciation. So again, since we figured straight line out at 48,000 a year, and for year 2, we're obviously talking about a full year, so we would recognize the full $48,000 of depreciation. Same thing using double declining balance. So again, it's starting with double there. It's setting up the ratio of 200% over 5 years times beginning book value. Okay, so that part I think is probably the most confusing. So maybe just, I don't like to think about it like that. I like to take 100% divided by the 5 years, give me the 20%, double that. Okay, so either way, that gives me 40%. Times beginning book value would be 1 year's worth of depreciation. Again, we're only talking about 3/4 of the year here, so we would again be figuring out what 1 full year's worth of depreciation is, and then multiplying that times 75%, and that would give me my depreciation expense for year 1. Okay, so with declining balance, a double declining balance, remember, all I need for year 2 depreciation is whatever the beginning book value is in year 2 times 40%. Okay, so we will take 280,000 minus 84,000. So that would give me 196 here times 40%, and that will be my year 2 depreciation. Okay, any questions on that one? All right, straight line depreciation, 4-year life, $2,400 salvage value. Beginning of the 3rd year, okay, so this is a revising of an estimate, right? So we said initially it was going to be 4-year useful life. We had 2 years go by, and we're saying now instead of 2 years left, we're going to have 3 years left of useful life. Okay, so at that point in time when we decide to make the change, we will take the book value at that time. Well, I guess let me walk through the first couple of years here to get us where we're going. So first thing here, we're going to recognize year 1 and year 2 depreciation. Okay, that is just getting us to where the question started us at. Okay, so now at this point, I take my my book value, which is right here, so 13,130, and instead of dividing that over the, well, I guess I still need my revised salvage value. Okay, so originally the $2,400 salvage value, now I'm saying there's a $2,000 salvage value. So my new depreciable cost is 13,130 minus 2,000. Okay, so current book value minus revised salvage value equals new depreciable cost, and we will just divide that over the new useful life, which is 3 years. And so 11,130 divided by 3 gives you the amount that we're going to recognize over the final 3 years here. So 11,330 divided by 3 gives us 3,701 or 3,710 per year. And so that's what we would recognize these last 3 years. Questions on that one? Might be all I have. No, one more. What time is it? Oh, I got a couple minutes. All right. Oki Company pays $264,000 for equipment expected to last 4 years. Have a $29,000 salvage value, and we want the journal entries related to the following costs related to the equipment. All right, so we got 3 additional costs, and basically what we're looking for here is, hey, do I add these costs to the asset and then, so they will be depreciated over the remaining life of the asset, or are these costs associated with upkeep and maintenance, and should they be expensed right away? That's essentially what we're looking at here. Okay, so for the first one, we've got $22,000 for a new component expected to increase the equipment's productivity by 10% of the year. So what that, in parentheses, you see betterment there. We're basically saying we're improving the quality of this asset and kind of fundamentally changing its nature to be better. So this is going to be something that gets depreciated. You can also look at the amounts there and you say, okay, $22,000 is, depending on the company, may be a significant amount. And, if we're using that, whatever we've done to the equipment over a period of years to help us earn revenue, it makes sense that we're going to depreciate that. So what this journal entry is telling me, again, we're just trading one asset for another, and I'm saying, hey, this is going to go towards making this a better asset for the company, not just keeping it in its present working order. Second scenario is the opposite of that, basically. We're saying, hey, this is not changing anything fundamentally about the asset. This is just keeping it in general working order. So this would just be immediately expensed. So you can see the difference there is under the second example, that would show up and lower my net income for the year because as an expense, it's on the income statement, it lowers net income. Up here, you don't even see anything other than 2 assets, right? So, as far as our financials are concerned, this is swapping one thing of value for something else until I start recognizing depreciation expense on that item. So finally here, we've got something that's a high dollar value that will increase the useful life of the asset. So I would hope that this looks to y'all much more like the first example than the second. So again, this would be trading one asset for another. Equipment goes up, cash goes down. All right, that's as far as I want to go today. I might have 1 or 2 other examples listed on there, but I'll throw the answers to the last example up with the slides. Let me know if you have any questions. If not, I'll see y'all next Tuesday. Yeah. Okay, do it, please.
Sorry if I was kind of tired today. I only got 2 hours of sleep last night.
No worries. I totally understand.
I made the genius decision that my bed sucks. Let's try a hammock instead.
I've learned that those types of things are good for naps, but not so good for sleeping the night through.
The problem is that hammocks are thin, and when things are thin, they get cold.
That's true.
Have a good weekend.
Yeah, you too. Hey, see ya.